Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And welcome back. Caught me off guard there. Anyway, like the guy said, this is the Bullington Capital Report. Glad to be here. Glad any listeners out there are listening. And I guess I'll just start off by reminding everybody, next Saturday morning, before the radio show, we've got a seminar coming up, and we're going to be showcasing some new technology that we're going to roll out to, we're actually slowly rolling out to all of our clients. Eventually, it's going to be to everybody, and then to the general public. And there are technologies to help you stay on track with your investments and financial plans. And I got to tell you, these tools, the more that I work with them, the happier I get. It is so simple. The things that are the hardest about a financial plan, the software makes a lot easier. It makes investing easier. And we'll talk about why that is a little bit later on today's program. But I just wanted to let you know that we are going to be talking about it. It's next Saturday morning, 8:30, Corporate College on the East Side. You can go to my website, bullingtoncapital.com, to sign up, and there is no cost to attend. And I think it's going to be a really good time. And we'll talk about a lot of the things that we normally talk about at a seminar, but we're really going to be showcasing this because it helps you stay on track. You can stay right on top of everything. It's got they're calling it a financial dashboard. And incidentally, this company is a company that's owned by Fidelity that sells software as a service to people like me, who then turn around and make it available to their clients. So you can track your spending. You can track your credit cards individually or together. You can see all of your spending in one place. You can do budgets on it, and you can track your investments. It shows you how your portfolio is allocated, the total values of all your accounts all over the place. There's also a digital vault. If you have important documents that you'd like to have access to, you can do this. We can help you upload it to a file folder. We can show you how to do it. I think it's easier. It's easier than the one that we use for our office. And anyway, it's really a fantastic tool. There's a retirement planning piece of software built right on there. I'm going to show everybody how to use that kind of stuff when we do the seminar. So it's really nice. It'll take that burden. And this is one of the things that I found in my industry that people have a tendency to struggle with. Nobody likes to track their investments or their spending because it's hard. There's a lot of effort to it. Well, this takes care of that. Once you set it up, there's no effort. I mean, you just log in and check it out. How cool is that? And modern technology is amazing. And it's mind-boggling. We've tried this service before, by the way, and it just wasn't quite ready for prime time. It wasn't to the place that it is today. So, again, if you'd like to sign up for that seminar, just go to bullingtoncapital.com, click on the seminar tab or highlighted word. It'll take you right there. Again, there's no cost to attend. Seating is limited, and I think we have about 40 seats left out of 100. And so hopefully we'll see some of you there. And if you hear something, by the way, on the show that you'd like to ask questions on, feel free to go to the website, click on the Contact Us, and send us an email. I'll be glad to respond to any emails that we get. Maybe you can't get to the workshop, got a couple questions, or you hear something else that we talk about on the radio program. Please feel free to give us a call. We kind of, our specialty at Bullington Capital is really retirement planning. And I used to like to call it financial freedom planning. How much money do you need to accumulate? How do you need to invest to be able to retire without cutting back in your lifestyle and not having to go back to work? That's sometimes that happens, by the way. It's happened to a lot of people. through no fault of their own in many cases, but in some cases it's just because there was a lack of quality information. And I hate when that happens. Yeah, it's out there. One of the things that we, really try to work hard on is to try to get the information out there. And I'm gonna put out a little book for 12-year-olds. I think. I don't think I know. Now, the Three Stooges would say, I don't think you know either. but I am going to do this. It's a book, because by the time you're 12 years old, incidentally, you've learned enough math to do everything you need to know in financial planning. See, because you already have percentages. And percentages, you need to get really good at it. Okay? And by the time you're 12 years old, you've already learned it. If you apply that into your financial life, boy, people could have such easy lives when they got to the age where they wanted to stop working. And it's something that every 12-year-old should know, by the way, because when the hormones kick in a year or two later, you won't be able to talk to them until they're 30 or in their mid-30s. And sometimes never. So you got to get them early. It's a major task. I mean, think about it. If you're going to withdraw 4% a year, let's say you're going to do a 4% withdrawal rate. I typically do 5%. We can go into why that is at the seminar. But let's say 4%, because that rule is thrown about by a bunch of financial planners all over the planet. Anyway, so you're going to take 4% out of your assets, and you've got $1 million, or let's say you got $500,000. Well, 4% of $500,000 is $20,000. That's before tax. Okay. 4% of $500,000 is $20,000. So if you're going to be taking out 4% and you want to have $20,000, you got to have $500,000 saved up. Not an easy task. That is not an easy task. But if you were 12 and somebody told you that, and you already knew percentages, and then you could go to a website like the one that we're setting up for our clients, and you can see how much money if you need to save to reach whatever goal it is you want to reach. We'll talk about setting appropriate goals in a second. Then, but you would know, and I'm telling you, kids would do a lot of things differently. I know I would have. I didn't hear this stuff until I was almost 30. And you know what's amazing is I majored in economics and minored in finance, and they didn't talk about this. The stuff that we learned in school was high level and not much practical use for it. It was great use if you were going to be a CFO or an officer at a big corporation. But for the personal financial planning stuff, it was, there was nothing. Now, I know that's changed, or at least I think it's changed. A lot of schools now, they have degrees, 4-year degrees in personal financial planning. And that's probably a good thing, although I think it's probably not necessary. When you get to the seminar, you'll find out why. And the primary reason is there are two types of financial planning models that are most widely followed. One of them is called a cash flow model. That's where you actually try to take an idea of what your current income is and do a detailed budget, a really detailed budget. That's the one that actually turns a lot of people off, because to do a really detailed budget means you have to go around tracking what you're spending everywhere. And not a whole lot of people want to do that. Now, there are people that do, and they're highly successful. If you're that type of personality, great. Then you need to do that. In fact, there are a lot of financial planners that love the cash flow model. Now, I'm in the other camp. I personally prefer the goal-based model. Let's set up a goal and let's set up a plan to hit it. Okay, and then the minor details, like how much I spend at Starbucks in a week, is inconsequential. Because if I'm doing the things I need to do to hit my major goals, i.e. accumulate enough money so I don't have to go back to work when I retire, I'm good. And you can spend the rest of the money any way you want. So, and I'm not here to tell you one way is better than the other. Actually, you've got to let your own personality dictate that. Trying to do something that goes against your own financial personality, not a good idea. It's not. A lot of people don't hear about that, by the way. They don't hear about the goals-based planning because the cash flow model was actually the one that was most prominent for years and years and years. And it's really just recently that a goal-based model. Let me give you a real quick example. Let's say you're going to retire 65 years old. You're going to call it quits. You're eligible for full Social Security benefits. You get a little pension at work, and maybe the two of them combined together come up to, I don't know, $2,500. That's roughly $30,000. And you decide that, if you had $60,000 a year, that you would be able to live fine. Okay, that's all you need, $60,000. Okay, so you're getting $30,000 from a pension, Social Security, and you only have to come up with $30,000 then. So if you've got $600,000 at 5%, that's $30,000. You should be good to go. Now, some people are probably driving off the side of the road right now because they just heard that you have to have $600,000 to generate 30. By the way, that's a 5% withdrawal rate. I think, I'm sorry. No, that's not a 5. Yeah, it is. 5 times 6 is 30. There you go. So that's a 5% withdrawal rate. At a 4% withdrawal rate, you would actually need quite a bit more than that. So that's the goal then. Try to, 60,000 is your number. That's the number you came up with. You said, I'm good with that. You're going to get 30,000 Social Security and pension. Then great. If you only need 60 at $600,000, you're good. You're done. Well, you've got the goal set. You're done with that portion. The next thing to do is to take an inventory of all the assets that you have, financial assets, and add them up, see how much you have to add to that and what kind of returns you might be able to generate. And those two things are widely variable, by the way. But that's why you need a planner. By the way, everything that I'm talking about right now is included on that website. It's part of the package. So how cool is that? And because I've been doing this for so long, it takes me about 5 or 10 minutes to put that portion together. And I'll tell you where it does get complicated is when somebody wants to buy a second home for whatever purposes, maybe someplace down in Florida to go to. Then that's another goal, and you've got to set that goal aside, and it's got to be not set it aside. You have to incorporate that goal into the other goals that you have. And in some cases, you might find out you don't have enough money. In other cases, you might find out that you have more money than you needed. So that's good. But which brings up another topic that just rolled into my mind. I was talking with one of my clients this week, and he's thinking about downsizing a little bit. He's got a house that's got, it's a colonial, so he's got stairs, and he's getting to the point where he doesn't, he's worried maybe 10, 15 years from now, those stairs are going to be harder to get up and down, and maybe he wants to get into a one-floor home. And so we're talking about it and talking about what he can do and what his options are. And it was really funny. He asked me if I knew a financial planner. I'm like, really? Okay. Yeah, actually, you're talking to one. Technically, I'm an investment advisor, but they are all closely related. I may have to go back and just reinstate just so people quit asking that question. But anyway, so we're talking about it, and I just guesstimated about $5 per thousand is what your monthly mortgage would cost. So let's say you went and borrowed $200,000. So 200,000 is 200 thousands, right? So $5 per thousand, 200 times 5 is $1,000. So that would be roughly the principal and interest payment. It's actually slightly less than that. I always try to overestimate, by the way. It's slightly less than that, but right around $1,000. That's pretty close. Okay, so about $1,000 a month. And that's what it would cost to borrow $200,000. Is that a good idea? Well, in some cases, not. If it's going to be more than 25% of your gross monthly income, I think it's a bad idea. Yeah, because that's a lot of dough. But if it's not, then hey, by all means, you can afford that. And those are the types of issues, that we're talking about. I think it's a great idea, by the way, that just started all kinds of thoughts going through my mind So I got on the phone and I talked to Alan Braccato. Maybe he'll call in a little bit later in today's show. He's a loan officer at Home Savings. And I was asking him about loans because one of the things that popped into my mind is they may not be able to find the house that they would like in the neighborhood that they would like. So what happens if you want to do buy a home and do some construction on it? Well, there's a specific type of mortgage for that. So you're borrowing, it's kind of like a builder's loan on a new property, except that this property already exists. What a great idea that is. And incidentally, a lot of people don't like the idea of taking on a mortgage, when they're in their 60s. Bank doesn't care. As long as you qualify, they'll lend you the money. If you've got the qualifications, they'll lend you the money. And I'm going to tell you that you have to have the question. The right answer is personal. It's a personal preference. Is it right for you? I hope I'm carrying a huge mortgage when I die. I really am. Financially, oftentimes it can turn out better that way than it does without it. And I know that sounds like total crazy talk, but it's not. If you actually do the math, there is when a corporation does it, it's called leveraging up the balance sheet. It can be dangerous if you go too high, if your leverage is too high. Absolutely, you do not want to do that. But having a mortgage, not a bad idea, especially when you get older. If you're in a house and it needs repairs, and you don't want to do it, this is a good way. That's a way that you should consider, because oftentimes the payment would be very small. It's going to be the majority of it's going to be tax deductible, because in a long-term mortgage, 30-year mortgage, most of the interest is paid up front. So you'd be deducting nearly the entire payment. And you'd be having those things put in your house so that you wouldn't have to leave your house instead of going to a nursing home and just modify the house. Yeah. How much cheaper is that? How cool is that? By the way, the house still appreciates whether it's paid off or not. So you get to keep that portion, or at least to pass that on to your beneficiaries. So I guess what I'm really trying to say is I'm not trying to talk anybody into doing anything. Just weigh your options and try to go into it with an open mind. Having a mortgage debt is not a bad thing. It really isn't, particularly if it improves your lifestyle. If you can stay at home, get home health care rather than having to go into a nursing home, I think probably worth it, probably a lot less expensive in the long run. So these are all the types of things that we deal with every day at Bullington Capital. And when we come back from these commercial messages, we'll talk about a few more. And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon right here in 1420. Also available on iTunes if you just go in and search for Bullington Capital Report if you missed it there. Or you can go to my website. You can download it there or listen to it there as well. That's bullingtoncapital.com. And I just wanted to thank somebody. I don't use their names unless I get their permission, but somebody had emailed me during the commercial break and was talking about getting the problem of the multiple or stairways solved by getting a stair lift, which is also a great idea. I had a very good friend. He actually died of Lou Gehrig's disease, very, very tragic. And he had one of those put in his house when he started having trouble getting up and down the stairs. And that is a good idea. And then he was able to have home health care come in. So again, back to one of the points I was making earlier. Oftentimes, if you don't have the cash, many times you can refinance a house if you qualify for it, and use those things to make those improvements so you can stay at home instead of going into a nursing home. And I think that's a great idea. Anyway, what else was I going to talk about? I forgot. If you'd like to call us, 216-901-0945, 216-901-0945. Again, we are going to be having that workshop coming up on July 22nd. I think this is I'm so excited about the software because it's gotten so good, and it's going right to the heart of the matter with the vast majority of people. How do you get a financial plan that's relatively simple that you can follow? And that's a major point. because people get really discouraged when they sit down and they're talking with a financial advisor for an hour and they still don't know what's going on or what's being proposed. It's frustrating. I get it. I do. So this service is going to help us a lot. If you can't get to the seminar, but you just want to see it, or you want to set up a phone call, talk to somebody in my office or myself, you can go to my website and just click on the contact form. We'd be glad to do that for you. I'm going to be probably the biggest evangelist for this software package in the country. And because it hits me right where I don't even know how to finish this sentence. It does something that I really like, that I think was necessary and needed, and it's relatively simple. That's, for me, that's the key. That it's not thousands of pages. Now, you can make your financial plan as complicated as you want it to be. There's an unlimited amount of things that you could consider. There are an unlimited amount of things that you could consider, that you could do, that would really make your plan incredibly complicated. And if you like to do that, that's fine. You can do that too. In fact, you look at that budget tool and how you're categorizing all the expenses that come in. Incidentally, one of the other benefits of using software like this to help you manage your investments is you can put alerts on there, and you can be alerted to stock price movements. You can be alerted to transactions that are going through on accounts. You get to determine how big you want that to be before you receive an alert. And any movements in or out, you can get alerts. It's awesome. I can't believe it's taken this long to get a tool this good, but I'm glad it's here. I'm glad it's here now. And we're going to be, again, talking about this probably for the rest of my career. The investment side is a little easier. We always talk about that, by the way. The investment side's gotten a little bit easier. Last 10 years, there have been an enormous number of exchange-traded funds that have come to market. Many of them have gone away, by the way, because they didn't get enough assets under management. So when the fund company is paying for all the administrative expenses, which are generally about $500,000 a year, those are the admin expenses on an average exchange-traded fund, about $500,000. That's before you take in any money, by the way. So a lot of them don't take in enough money to be able to pay those costs, much less the marketing expenses. So they end up folding and going away. Now, the ones that do make it, it's kind of interesting because they really write the prospectus and the name of the fund based on what they think the public will buy, not what's the best investment strategy. That's like marketing 101, and it has come into the financial services industry. So you get a lot of funds out there that are doing things that really are not that bright, but they sound good, and they it's tough. One of the things you want to do with your portfolio is to make sure that's properly diversified, that there's not too much overlap, that you're getting exposure into all the major sectors, and then you're balancing off the stocks between the fixed income, which bonds basically, in stocks to suit your own personal tastes, your own personal risk tolerance. That's a big deal. And that's hard, by the way. The vast majority of people really don't have any idea of the kind of risk they're taking. They don't. I can look at your portfolio and I can tell you in about 10 seconds how much risk you're taking. No sweat. You want to know why? Read the book Blink. Go get the book Blink and read that book, and then you'll know why. I won't leave you hanging. I'll tell you why. Because I've been doing this for an extremely long time period. And I don't care what you do. When you've done anything more than 10,000 hours, you're going to be better at it in that 10,000. I'm not even going to try to say that. After hour number 10,000, then you are in hour number 1,000 or hour number 200. Hour number 10 is about where the average person gets before they get frustrated and go on to something else. But and I get it. I do. It's this is not something that's incredibly exciting unless you're excited about it. Unless you can understand, the difference that percentages can make in your life. Unless you can understand the difficulty of actually disciplining yourself to reach your goals, to setting goals. then it's not going to be very interesting to you at all. And but if you are interested in it and all the kind of stuff that we're talking about, it takes a lot of time. There's just an awful lot of language there. You want to see how much language there is? Go to Investopedia.com sometime. It's an online dictionary of financial and accounting terms, and it is unbelievably large. And you will see thousands of definitions there, and most of them are relatively simple. But it is a different language. It's kind of like learning French or Spanish, any other language. They've got different ways of saying everything. So I don't know what you would call the financial language, but anyway, make a long story short, it takes a long time, and I can see what kind of risk they're taking and whether or not it would match their personality based on just a couple questions that I would ask. And the questions are relatively difficult, incidentally. It's like, how much of a decline are you willing to put up with in an effort to reach your long-term goals? Stocks don't go straight up. And if they did, and I wouldn't have a job. The stocks move in a very jagged fashion. They're up some days, down some days. And in fact, I don't know what the current statistic is. It's been a long time since I've looked this up. But a few years ago, stocks typically only spent 52% of the time going up. 52% of the days were going up. 48% of the days were going down, which means you can practically toss a quarter to determine whether or not the stock market's going to be up or down on a day. And by the way, that goes for years. Oh, no, not the 48-52. But you can actually have a really good strategy that underperforms for years sometimes. And it can be a great strategy and it's doing all the right things. Well, then why is it underperforming? Because right now people are taking on too much risk, and those risky assets are rising faster than the more secure ones. And that happens a lot. That, in fact, it's kind of the past 3 years, actually. The stocks that were fully valued are now overvalued because those are the ones that are going up. Sound familiar? It should. If you've been watching the stock market for any length of time at all, if you don't, go to freestockcharts.com, pull up the SPY, hit number 9 on your keyboard that converts it into a monthly chart, and look how wild that thing swings. And I do get that question a lot. Well, why don't you just put it all in the S&P 500? Because the S&P 500 has multiple 10-year time periods with negative returns. It's too aggressive. Yeah, great. If you survive, and think about this, if you retired in the year 2000 and you had your money in the S&P 500, there's a really good chance that before it got above 2000, or I'm sorry, above 25, or what was it, 1500? I'll have to look it up. By the time it got back to where it was when you paid for it and stayed above that level was 13 years. Think about that. 13 years. That's minus the dividend. But the dividend, it drops that back to about 11 years. So 11 years with negative returns. Are you telling me you are okay with that? If you are okay with that, so am I. Yeah, I can put you in that. No problem. Yeah, I'm not okay with that. I don't care what its long-term track record does, because that's not the first time that has happened. It's an aggressive strategy. What do you do? What do you do instead? Well, the smart thing to do is to try to diversify, to try to pick up some other asset classes, to try to smooth that out so that you don't have an 11-year negative time period during your retirement. It's a big deal. So, that's the one thing I think every financial advisor, for every financial planner in the country has trouble reconciling with their clients. Well, S&P's got a great tracker. Well, coming up off of a bottom, it does, and then it has a tendency to get ahead of itself, and then it crashes again. And, if you get in at the wrong time and you're not doing the right things, you're going back to work, or you're selling that house instead of getting a mortgage so that you can upgrade. I shouldn't be. I don't want to turn this negative at all. It's not really negative. The positive thing is, and where I was starting off with this whole segment, is that funds have been created to allow you to achieve a really nice level of diversification, that you can reduce and minimize the volatility much better than you could even 5 years ago. Last 5 years, there have been an enormous number of funds out there that have come out. A lot of them are not so good, but a lot of them are very good. And knowing the difference is kind of key. And you can't really tell just from performance. That does not tell you the whole picture. You have to figure out how they're performing and why they've outperformed. That's a big deal. If you really want to be a solid investor and you're looking at making investments in any type of fund or any type of strategy, really, you have to look at the long-term performance, find out how it was achieved and why it worked. And that's not always that easy to do. It's actually hidden in a lot of the prospectuses. The title of the fund and the way that they name it, low beta, low vol, all that kind of stuff, factor-based, that's marketing stuff. You really have to get in, read behind the lines, or between the lines. Behind the lines, that's funny. Read between the lines and figure out what they're doing. And that's what we're going to be talking about at that workshop, because I've got a really nice model I put together. A couple reasons. Department of Labor said you're going to have to hold these other asset classes. They came out with some guidelines, which have been changing constantly, by the way, driving me crazy. And now they say, well, they're not going to enforce anything until January. So I'm going, okay, I think I got it anyway. I've got a really nice model that I'm going to use to complement the stuff that I'm doing at Folio. At Fidelity, I'm just going to use that model because I think it's a big improvement. I think it's going to do better than probably 90% of professionals are going to do, before fees anyway. Why? Because it's what it's done in the past 5 years, and I understand how. That's the real trick, is understanding how this thing works. To construct a portfolio that gives you the best level of risk and return, you have to know what they're doing, how they have a tendency to work over time, and then put them together so that you're trying to minimize the level of volatility and you're trying to maximize the level of diversification. That is not easy to do in an index fund that's market cap weighted. That is not easy to do, like the S&P 500. That's overweighted in large cap stocks. And when large cap stocks go out of favor, you get an 11-year negative time period. That's what happens. Okay, don't want to do that, especially not near retirement. That is not what you want to do. So don't pay attention to whatever's gone up the most over the past couple of years. That's inconsequential. You got to look out over the next 5 to 10 years and try to figure out where you think the best risk-adjusted return is going to come from. And all right, now I can tell you, small cap stocks are more undervalued than large cap stocks, but a small cap market cap weighted index has way too much money in financial stocks. They get way too much money in financial stocks. So that could be a problem. That's a problem that's looming. The large cap, the part that's done the best, has way too much money in the top 10 stocks. You look at the amount of money that's in the top 10 stocks in that index, you start taking those stocks out and the performance drops like a rock, by the way. But because they're in there, it's been boosting the performance and increasing the amount of risk. So, because it's not a matter of if they're going to come back to normal one day, they're going to come back. And when it does, that means that particular index is going to be underperforming again. But the fact that interest rates are so low around the world means that money is not going to go to cash, more than likely. If it does, it won't stay there very long. It'll probably start to seek out some of these other areas that have been underperforming. So the person with the truly diversified portfolio probably been lagging the market the past 3 years and wondering why. That I just told you. And believe me, I'll be here next week to tell you again. So, I hear the music. That means I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answers. Stay tuned. I'll be right back.
The best things in life are free.
And we're back. Hey, feel free to reach out. Bill at bullingtoncapital.com if you have questions. You go to my website, click on the Contact Us form. You can interact that way. You can always call us. You can sign up for the seminar there. Seminar is next Saturday morning, 8:30. We're going to be rolling out some new technology that's going to help you keep track of your investments and all your spending. And actually, it can do anything. This software is unbelievably powerful. And for a while, we're providing it free of charge to any of our clients that want to use it. So, and more than likely, I'm not going to bill for it to clients anyway. But it's a good service. It's an excellent service. And if I'd had something like this 20 years ago, this would be awesome. But it's here now. And you don't have to be really adept at technology with this one. That's what I really like about it. That's what I was waiting for. This software has actually been around for quite a while. It just wasn't user-friendly. And now it's a whole lot more user-friendly. So we're going to show that how you do a retirement plan in about 5 minutes. It's great. I just can't say enough about it. So I'm glad to be offering it. My staff has been working extremely hard, and I'd like to thank all of them. Gary Miller, Melissa King, and Melissa Arcuri. These guys have been busting it to get up to speed and get our clients in, get their accounts all established there. By the way, this has the latest military-grade encryption technology on it. It's got alerts, too, you can set up so that if something does happen, it's going to alert you to that fact. And it's just a really nice tool, and I'm really glad to have it. And anyway, by the way, I keep forgetting, if you want to call in, 216-901-0945, 216-901-0945. And I probably have some of the stock pickers out there dying because they haven't talked about stocks all day. And by the way, I will always trade a little bit of my own money, and I run a small fund in a small portion of that, but I really don't have the kind of time it takes to do that full time. And another thing I'd really like to kind of get off my chest is oftentimes I get clients that want me to watch an individual stock for them. And I don't think they understand what I do all day. It's really impossible, but I can tell you. And now you can set up your own alerts. And I can tell you how to do those things if you want to do them on your own. But I can't just watch individual stocks for people. And by the way, no other investment advisor in the country does that if he wants to keep his clients. But anyway, I have to talk to, I'm going to the phones right now, and I got Joe.
Yes, good morning, Bill. I heard you mention something about those interest rates earlier, but I don't know if your mortgage guy called up or not.
He did not.
I sell real estate here in Northeast Ohio,
okay.
And I looked up in my calculator for a 4%. You're absolutely right. You can get 4% here in town,
right.
Even a little bit less than that.
Yeah.
But the current rate, now this is just principal and interest,
right,
would be $4.78 per thousand of your mortgage.
Cool. So if you borrowed $100,000, it'd be $478.
Exactly. That would be your monthly principal and interest mortgage.
Yep. Great. Well, thanks for calling and letting us know that. You want to give yourself a plug?
I go by REO Joe here in Northeast Ohio.
Right. Okay.
And my direct line that I try to answer around the clock is area code 216-901-1416. And like I say, that number I answer around the clock for my customers. Anybody has any questions, be happy to talk to them.
That sounds good, Joe. Thanks for calling.
Thanks, Bill. Look forward to your next seminar that you have. It's also excellent.
Oh, thanks. I appreciate that. I'll see you next week. Yep. Bye-bye. And I'm going to go to Jerry. Jerry, you got a question?
Yes, sir. Good morning, William. Any option, what is a strangle?
Let me see. I'm trying to remember. It's a combination. You're going to do a put in a call. You can be long strangles or short strangles. There can be tons of differences based on the premiums and implied volatilities. When you ask questions like this, you know you're the only one on the planet that really wants to know the answer, right?
Well, that's key to my next question in investing.
Okay.
Okay. Well, actually, my second question. Okay. Do you know what an iron condor is?
I used to. You're actually going to be either long the two options in the middle, short the two on the edges, on the wings, or the opposite. I can't remember because it's been so long. And by the way, you should not be doing that stuff. You can get blown to pieces doing that.
You can also generate about a 15%.
And you can get blown to pieces doing that.
Well, let me go into my next scenario. Say, for example, I have Cisco now. I'm long on it. I own 500 shares. All righty. Now I'm going to sell a covered call against. I'm going to sell five calls. Now, should it go? Say if it's a 30, it goes to my options that say 32. Or I've sold the option of 32. It goes to 33. All right. I'm going to obviously going to be losing money, or not gaining as much money as I could on the long sale of the stock. Correct? I am going to be getting some option premium. Correct?
Actually, it really depends on what happens before that thing. You won't know until it actually expires.
Until it expires.
Yeah.
Until it expires. Yes, sir.
Right. Yeah.
Okay. Now, what happened? Again, the scenario is I purchased it at 30. I sell covered calls at 32. It's at 33. Now, if it makes a quick movement up to 33, what's to say I can't sell puts at, say, 28 or 29 to recoup that difference?
Nothing is to say that, but I can tell you, man, dude, one of these days you're going to get clopped. And that's exactly, there's this guy, his name is Victor Niederhofer. You need to go Google that name, Niederhofer.
I will.
Okay.
Okay.
This guy was doing iron condors. It was doing all kinds of spreads for 30 years, and he was knocking the lights out. The net return to his investors was 22% after his fees, which were 3 and 30.
Okay.
And then he bankrupted himself, all of his investors, and the brokerage firm that was carrying his orders in one day.
Wow. Well, obviously, it must have been a catastrophic move in the market.
He was doing a lot of the same stuff that you're doing. And I'm telling you, at some point in time, you'll get beat up so badly doing that it's going to wipe out profits for years, if not take it into the loss category.
Well, if I do the Bullington concept, whereas I never have more than, say, 10% in my portfolio and do that, then it's going to be a profit increase.
Then you might only be down 20% of your entire profit.
Well, if you're generating 20% or 15% a year, then you're probably not going to, you're not going to like it, but it's going to be still fairly advantageous.
Well, on 10%, it would add at 20% a year, you'd add 2% a year to your total returns, and you'd be working your butt off.
Okay, well, I appreciate your candor or your opinion. I just wanted to see. So you,
yeah, no, if you're,
I didn't think that you thought it was a great idea, but
no, if you're retired and that's what you like to do, okay, it's a hobby. Okay, so and if that's what you like to do, then by all means, then go ahead. Just be safe. And if you're asking me these questions about iron and you're not really sure how it works, you should not be doing those things.
Well, I don't understand. I don't do iron condors or strangles. I'm just curious what they are because I've read about them. There's
a book, and it explains every options. By the way, I passed a Series 9. That's an options principles exam. Only 1 in 1,000 people in my industry have ever passed that.
Okay. Oh, good.
But
congratulations.
Having said that, that was 15 years ago, and I haven't done an iron condor since then.
Okay.
Because I saw the risk that was involved, and I saw the potential return, and I'm going, man, this is only going to make the market makers rich, not me. And it just, there were very long runs for very short slides. And I like you a lot, but I'm telling you, dude, the stuff, you got to get that book, Options as a Strategic Investment. It's only 800 pages. Okay. And it's going to tell you everything there is to know about doing options. And
okay. I was just going to ask Bill one last thing. What's this gentleman's name? You said Victor
Niederhofer, yeah. Yeah, Niederhofer.
Was he an American or?
Yeah, he was actually a stats professor. I think he worked at University of Chicago. You know where the Securities Research Bureau is? And,
of course.
Yeah, well, this guy's a PhD. The guy is super brilliant. But when you're trying to get consistent small gains, which is what he was doing, it was trading every month. When you're trying to get consistently small gains and have very small losses or losing periods, you're going to have to take a strategy that actually has an enormous amount of risk. And the fact that he went for 22 years before it actually blew up is mind-boggling. I mean, that's like winning the lottery 3 times.
Yeah, no doubt. So,
And,
okay, well, I will Google it. I appreciate
Yeah.
the name and the advice as always. Thanks,
well,
Bill.
thanks for calling.
Yeah, bye-bye.
Yeah. I'm sorry. I'm normally not that animated, but that is, those are really risky. I mean, really risky. I can't emphasize enough that's not, and I've done it. You know, I've got the license. I wanted to understand everything there was to know about it. I got a commodities and futures license. Yeah, I had other principals exams so that I could actually do this in my office because my branch manager was so afraid. He didn't want responsibility. And I get it. It's really risky. You don't need to do that. But, you know, if it's a hobby, I can tell you which books you need. If you want to do options as a strategic investment, get the book. It's the Bible on options. And study that book until you know it inside and out. And even then, by the way, Victor Niederhofer knew that book. He knew the same thing. So it's hard. Investing can be really hard even when you're doing all the right things. But if you do the right things, eventually it pays off. It reminds me of that song. You can't always get what you want, but if you try sometimes, you might just find you get what you need. Anyway, you've been listening to Bill Bullington right here on 1420. I'm here every Saturday morning from 11 to noon. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.